No, God, no. I don't
No.
like gyms.
No, that's a no. Nah.
That's a no. That's
Nah.
a no. That's a no for me.
Nah.
Yeah. 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 No. Yeah. Nah. Nah. Yeah. You drink that water. It's good for you. Stay hydrated.
I love it. How are you guys doing?
Well, my office is a complete disaster bomb zone, so that's fun. But
that's wicked. Bikes for kids. I love that. All right, we're back with the Nowiks and myself, Nolan, Matthias. We've got Greg and Miles from the Nowik Mortgage team, and this is the Real Estate 100 show. We've got an interesting show, an exciting show today. We're going to talk bank failures. We're going to talk the Canadian real estate market and the surprises that just keep coming. And we'll see if we got any other topics at the end that might be very, very interesting. So how are you guys doing? What's going on out in Nanaimo, BC today? Oh, the phones are ringing. That's a good sign.
Don't get it. Don't get the phone.
Ringing. He's busy.
Stay away from the phone.
Good thing we record on hump days as opposed to on Mondays or Fridays, right?
If you told me to record on Mondays, you'd be catching me. My hair, it would be even messier than it is now. I wouldn't have had coffee by then. It wouldn't be good. It'd be a cranky mess.
No kidding. My favorite piece of advice for realtors that made my life so much easier, and theirs a lot easier as well, was never write a financing condition for a Friday, because that is the single biggest day. And there's going to be 2 days in between that and when you can get your financing extension, because your financing condition is on a Friday and the banks are busy and the brokers are busy and everyone's busy and you aren't able to extend it, then at least if you wrote it for a Wednesday or a Thursday, you aren't going to find yourself in a scenario where you've got to convince that seller to wait 3 days instead of just 1 or 2, right? So,
and it's funny, a Monday is probably even better because you get to the weekend and you've got a whole 5 days to deal with, which is kind of nice, right?
Yeah, absolutely. We always just told people, it's like, just don't write it for a Friday. Don't write your closing date for the last day of the month, especially if that's on a Friday. And just don't be just think a little bit ahead. Get your realtor to think a little bit ahead, and try not to make that the most stressful day of your life by just putting some forethought into it. So maybe a Tuesday or a Wednesday, a couple of days before the end of the month, when all the lawyers have some time and all the brokers have some time and all that stuff, right?
Well, if you put it on a Friday and something goes wrong, you're not just ruining your day. You're ruining the realtor's day. You're ruining the broker's day, because the realtor and the broker are going to have to work now.
Yeah.
Right.
Yeah.
Maybe any of their plans just go out the door.
Yeah, exactly. Exactly. And we know that realtors always have, this is the Real Estate Agent Bashing Show episode of the Real Estate 100 show. Don't worry, next time we'll have a realtor on to defend themselves. But that realtor's got something planned for Friday afternoon that probably involves margarita, right? Especially as we come
or a golf course, right?
Yeah, I was going to say golf course.
That is not where you'll find me on a Friday afternoon ever. Yeah, it is.
So the slide you had up earlier was on bank failures.
Yeah. So check this out. Obviously, we were all in the business in 2008 when the real estate crisis happened. And the big thing about that real estate crisis was that they let a couple of big banks fail, and had they not let those banks fail, probably wouldn't have been as bad as it was. But now looking at the numbers, and this is a New York Times article, this is the U.S. bank failures in 2008 versus 2023, among other years as well. And it's adjusted for inflation. So in other words, this is dollar for dollar. And if you look at the 3 most recent bank failures, they exceed the number of banks in value that crumbled in 2008. So there was, I think it was 500 banks between 2008 and 2015 in the US that failed. And basically what happens is the FDIC takes them over and then they sell them off to another bigger bank. And ultimately that's what's happening with all of these banks, Silicon Valley Bank being the one that was the biggest in the news, and now First Republic being the second biggest bank failure in U.S. history, $213 billion, which is an absurd number, right? And it leads to a whole bunch of questions, and some questions that I think I want to point to Greg at. And we've talked about the story of coming off the fishing trip, coming into cell phone service in one of the other episodes. So make sure if you want to see that story, you go and you check out the other videos. But we talked about kind of learning that happened. What we didn't talk about is what that meant for the mortgage holders. And by the way, when this all happened, this affected a pretty significant amount of Canadian banks and Canadian lenders, because we saw a lot of lenders disappear from the Canadian market pretty much overnight in 2008, right? So, what do you remember about that, Greg, with respect to the banks coming and basically, well, the banks that left, let's say, and what happened to the people's mortgages when those banks failed or when those banks left Canada?
I think more of what happened was around values because unfortunately we followed suit with what happened. Our banking is really tight, so we didn't have the same issues they had in the United States, but we saw terror uh, go through people, and we saw values drop in our housing market by 25% pretty well overnight. And so, people that had bought a home and put 25% down, or people that were building homes, we had a lot of construction financing going on because before that, it was really a busy market. All of a sudden, 25% equity in there was gone. So, and then you're holding on these properties and selling them at lower costs. So we saw a lot of people really, really suffer through that time period. It was devastating. It was absolutely devastating. And the beauty of our situation is we keep coming back to the most important economy is your own economy and what comes out of your pocketbook. So, and how do people adjust to that? And you know what? You had to adjust pretty well overnight. And there was lots of people that lost lots of equity. So I think losing touch or losing the opportunity to deal with some of these institutions that a lot of them were from the US and were lending up here in sort of the alternative stream as well. And all of a sudden they pulled out, it caused a lot of havoc. So our Canadian banks, bless their hearts, kind of came to the party and helped out a bit.
Well, you'll find this one interesting because this did not exist, what I'm going to show you right now, back in 2008. And that is that there's at least two of the biggest banks by total assets in the US that are Canadian banks now.
Wow.
And this is because a few Canadian banks went on buying sprees in the US after all those bank failures. And this is the one that's interesting because we've seen the stories about TD Bank now being the most shorted bank in the world.
Mm-hmm.
And I haven't really have you guys dug much into why that is?
Not hugely. I think it really boils down to exactly this. People are looking at it going, okay, there's cracks in the banking system in the US right now.
Mm-hmm.
And TD Bank is very involved in the US's banking system. So they're kind of, combining those things together a little bit.
Yeah.
I think that might be it. I mean, I haven't done a deep dive into it, but
the other part of it,
speculate.
The other part of it too is that diversifying, and if there's if it creates opportunity, why not go after it? I think that's the big part of it too.
Yeah, absolutely. And they definitely did diversify into the US. Now, the big thing here and the big difference from what I can see is that the Federal Reserve and the FDIC in the US are making sure that these banks, if they do fail, are basically swept up pretty quickly, and they are and the depositors are made whole. That's a little bit different than what happened in 2008 when they let Lehman Brothers collapse and decided not to inject a bunch of money. Now you see, I think it was a bunch of the big banks injected $30 billion into First Republic Bank last month. And the reason why they did that was because they knew as a whole they needed to protect the system. So it seems like this is a little bit different than 2008 from the perspective of they're protecting the system better, which would imply that we're not going to see massive reductions in real estate values because the banks aren't being let fail in the exact same way. But it leads to an interesting conversation around what's actually happening in the real estate market. And we when we got on the call here, you guys were talking about what's happening in Nanaimo. Fill me in on what's going on out there, or I guess in Vancouver Island, I should say.
Well, it's kind of happening a lot all over BC, really. What we're seeing is house prices are increasing, not to where they were during COVID. I don't think they're going to get back up there, but they're definitely going up. We're seeing more multiple offer situations. We're seeing, things are selling for over list price again and stuff like that. We're seeing a bit more action and a bit more activity in the market where, it's almost like it's recovering a little bit. Now, some people are saying it's just a blip. Some people are saying, no, we're going to continue seeing prices rise until the end of the year. But I mean, only time's really going to tell us on that one. But it's definitely picking up. You know, I mean, we're going into the spring market. The weather's nicer. People are looking at houses more. It's going to boost the values. We don't have enough supply to meet the demand, so it's always going to have an effect on that value of the home.
I think Miles, you're right. Like you hit it real solid there as far as supply and demand, and I think that's the issue. We just got an email yesterday morning from one of our realtor referral sources in Victoria, where prices have dropped to 10 to 12%, but they're back into multiple offers and seeing they just don't have enough product. More listings, but still not enough product. So is that an element because rates have dropped a little bit and people are a little bit more confident on being able to get out there and change or buy their home? It's hard to say. And in Nanaimo, like Miles says, we're right back into where we were, not quite pre-COVID or through the first 2 years, but we're back into the situation where when you're driving down the street and the listing went up yesterday, it's sold today.
Yeah. They're gone in like 24 hours, 48 hours.
Yeah. And Calgary's pretty much the same, right? We're seeing Calgary really never suffered the way that a lot of other markets in BC and Ontario did. Toronto, it looks like same sort of thing. And now this is the market where I thought if it's going to come down and it's going to kind of chill out, this is the market where it should happen. But what we're seeing in Toronto this last month is that there's more tightening happening. It's getting harder again to buy a home in the Toronto real estate market. Here's some interesting stats. Let's see if I can pause this while it's up here. Vancouver. So what are they looking at here? Housing boom. Number of units. I don't know what they're looking at here. It just kind of came up. I think with
well, I think
new construction activity is what they're looking at here. So 15% in Calgary, 7% in Ottawa, 8% in Ottawa.
Look at Vancouver though, 0.1% or minus 0.1%. It's going down.
Yeah, there's no way for them to build new homes out there right now because
it's just And if you can't build new houses and you got people that want to buy houses, it's simple. It's supply and demand. Demand is high, supply is low, prices go up.
It's funny. One of the other things that's happened here locally is they're building a lot of rental units. So condos, townhouses, that kind of stuff. And that's something we haven't seen in the past either. So now we're getting additional housing for rentals, which is going to be pretty positive. I was talking to one of the guys who goes on our fishing trip, who runs a real estate office in Vancouver yesterday. And he was saying the same thing. He said, we went from where it was pretty quiet and we may have had a small number of sales last month, whereas this month we've already bypassed it. We're only the third. So, it's a totally different animal, and it just seems to flip overnight, and it's supply and demand, and it's just consumer confidence.
Oh, totally. I'm really curious to see, because we are seeing those rental units being built and stuff. I'm actually really, really curious to see what that's going to have in the way of an effect on the market. Because I mean, if you look at the cost of renting, it's pretty astronomical. Like it's bad. It's your cost of renting is about the same as owning a house, except you can't buy the house because you can't debt service it. So I'm really curious to see how that's going to affect the housing market. Like, is it going to make the housing market pull back a bit? Is it going to allow people to save up more money to buy houses in the future? Or it's a real toss up, because if all of a sudden you got all these people who are renting and it's less expensive to rent, they can save up money. Is there going to be another influx of buyers into the market? Is it going to push that amount up of accessible buyers? It's going to be interesting, but
yeah, no kidding. And it's just kind of like this balancing act, right? When you look at renting versus buying.
Oh, totally.
As values go up, rents might seem like they're going to get cheaper, but they often don't.
They don't. Well, I've always I own a rental property myself, and I've always said, you can basically directly see what's going to happen to the cost of renting if you look at the cost of housing. No one buys a rental property as a way to break even or lose money. If someone's losing money on a rental property, what do? They sell it. Then it's no longer in the rental pool. It's off the market for rents. It's one home that can't be rented out. So it's definitely a balancing act. 100%.
It's really dependent on where you live. Holy smokes. True. If you're living in Salmon Arm or Revelstoke or Grand Prairie, it just depends on where you live. And now, of course, the beauty is that we can be doing this stuff and we don't have to live in the big centers. So we see more and more migration to to the smaller centers because it's affordable. And it's funny,
Absolutely.
you look at a big center like Vancouver where they, everybody wants to be downtown, and all of a sudden they're pushing out further and further. And when I grew up, I lived in Port Moody, and then we lived in North Van before we moved here. And now, Chilliwack is close. People are going to Hope. And in Victoria now, they're living in Langford. Well, Langford now is close. So now they're living in Shawnigan Lake and Mill Bay. And, all of a sudden those areas, and then traffic becomes an issue. And so we're all working from home.
Well, I think
we don't wear pants anymore. So that's perfect.
You're wearing pants, right, Greg?
No, I'm not wearing pants.
Okay, I'm wearing track pants, so it is what it is. No, it's interesting too because you see. Or sorry, Nolan, you were going to say about your pants.
I was just going to say, I'm sure glad we got footage of Greg changing his shirt 3 times leading up to this episode.
Oh, that's going to be so nice to cut into. It's gonna be
I can change it again if you want.
I think you should. It's like, what is it? The Oscars or the Grammys, where there's like a million outfit changes and stuff, and the dresses or whatever.
My favorite shirts in the whole world are Robert Graham's. They're very flashy and they're flamboyant. And so we were down in Scottsdale last month, and Cindy bought me a white shirt, and it just has Robert Graham's face on the front of it. And I said, "That's what I'll wear next time." That's perfect.
That's gold. Actually, but do you think we can get them to sponsor?
Oh,
there you go. Yep,
I wear a Robert Graham shirt every time.
Right on your chest,
right?
Who is that though?
Robert Graham?
Yeah,
I don't know, but he makes great shirts and great belts. Now he makes jackets, shorts.
My favorite was those shirts you used to get that made you look like a giant Easter egg.
Oh, I miss those. Oh,
I miss those. They were great.
Seasonally.
If anyone out there is wondering what I'm talking about, Cameron and Modern Family.
Oh, there you go. Yeah.
Yeah.
He wear them all the time. Him and
those
me.
Shirts.
Yeah. So Cameron and me, we wear them all the time. Family events. Beautiful. People wonder what shirt I'm going to wear next.
I like how we went from the cost of housing and all this stuff, and now we're talking about Greg's shirts. That took a really that was a stretch, but it was really natural and organic, and I appreciate it. That was good.
Well, I was I apologize that we let it go down that path.
Rabbit hole.
I was trying to find this, and I'm just going to share it from Daniel Foch. Daniel, when you listen to this and when you watch this, let me know how to say your last name. So this is a buddy from Ontario, does amazing stats packages all the time. This is what's really interesting, and this is, I think, what the problem is. So in this little Instagram reel that he has, there's a stat on taxes for different industries and the production in different industries, and guess which one has the single highest level of taxation in basically Canada? Or I guess this is an Ontario number, and I'm trying to figure out where the actual Ontario number comes from. But basically, it is. Let's see if I can find it here. Basically, it's housing and the amount of taxes associated with housing. Here it is. Okay. So I'm going to pause it when it gets to the screen here. But basically, if you look at the production taxes on new homes, like nothing else is anywhere close.
Wow.
So here's the big problem is there's so much barrier to entry for builders to actually want to build homes. They've now got higher values on the land, higher interest rates. They've got more taxes. They've got more headaches when it comes to municipalities. Like the incentive to be a home builder is just, it's insane.
Not good.
No,
their costs have gone up. It takes longer to finish.
Yep.
So yeah, that's tough. And of course,
in certain areas, they're struggling to find workers too, right? Like, I mean, how are they supposed to build houses if the costs are too high, the labor is not available? Like, it's just not fair.
Well, and we also have, you don't have this tax in Alberta, but we have property purchase tax, right? Property transfer tax.
Mm-hmm.
That's a fun one.
Yeah, and so you're 1% of the first 200, 2% of the balance, and they only have an exemption up to $550, which is partial. So, and where can you buy a first-time home?
I'm pretty sure it's $525. It's even lower
for that price range, right? So, it's ridiculous. And then they bring in this foreign tax. So you've got buyers that want to buy from overseas that are from here. Like, I don't know. It's just
a bit of a mess.
Yeah.
No, the property transfer tax, that's a big one. I had a client who was looking to buy their first home, and it was a new build, right? Like they had worked really hard. They were at a point where they could buy a brand new build home, and new build homes are exempt from property transfer tax up to $750,000.
Yeah.
Buy me a brand new home for $750,000. And, and like Nanaimo's not huge. We're not some big giant city. We're 100,000 people. We're pretty small. You're not going to find it here. You're not going to find it in Victoria. You're not going to find it in Kelowna, Kamloops. It's a big one. So I'd love to see those stats and those numbers based on, I'd love to do some research on those on BC and see what they look like. Because
this is kind of funny too. I just pulled it up quick, but BC property transfer tax is the taxes paid on real property transferred in our province, right? And it was brought in 1987. The average price of a Greater Vancouver home in 1987 was $148,000
beautiful
in Vancouver. Drop the mic.
And that's in 87?
Yeah.
Wow.
So you're talking about a $1,400 transfer tax back then, and now it's $5-6 grand.
Yeah. Well, if you're on $1 million, you're 1% of the first 2 and 2 of the next 8, right? So you're 16 and it's ridiculous.
All I hear out of that too is I'm never selling a house that I buy. I'm going to do everything in my power to hold on to every single one of them.
That was in a previous episode too, I think.
I think it was too, wasn't it?
It was. Hold on to your homes.
Yeah.
Right.
So,
and I think we had Greg talking about that, and Tony Spagnolo. Is that how you say that?
Spagnolo.
Spagnolo.
Yeah, you have to Spagnolo.
Is he making a spaghetti sauce? Is that what's happening?
I think he's going to.
He should.
Yeah.
I'm expecting a box at my door of just a bunch of jingling jars in there.
Spagnolo.
And
I just love saying his name.
Beautiful.
Yeah.
We might have to go into the spaghetti sauce business and try to get his recipe.
So
sponsorship.
But lots of I mean, this, just and we also talked about affordability before. So holy smokes, like get your parents to help. That was in this one too.
Yeah, totally.
Oh, absolutely.
Why wouldn't you?
Well, I mean, if you look at that stress test rate, I mean, especially in I feel bad for people in Vancouver. Like in Nanaimo, we're still lucky. We can still buy houses for under a full $1 million, right? But like in Vancouver, different animal. If you're buying for over $1 million, you got to have 20% down. It's a whole different kettle of fish.
Mm-hmm.
It's expensive.
Yeah, not to mention the premiums you have to pay on interest rates for that, right?
Yeah,
100%.
And you think of when I bought my first house. All right, that was 100 years ago, but we if you put more money down, you got a better rate, and it wasn't very much back then because there was no discounting. And now it's a totally different animal.
It's the opposite.
That's probably for a future show too, right?
Yeah, you put more money down, and they're like, "Oh, okay, good. Your interest rate went up."
What?
How does that work? I get it. I mean, I get it because I work in the industry. I understand. I'm picking up what they're putting down, but for your average consumer to be like, "Hey, by the way, if you put more down, they're going to charge you more on the rate."
Mm-hmm. Until you get to 35% down, and then it goes back to the other rate. And
really,
they're just like, well, I mean, just to get into that a little bit, I think what's interesting about that is what people don't understand is that the banks are paying for what we call back insurance or portfolio insurance in order to make it so that your interest rate is lower, but the insurance is more expensive at 20% down because that is the highest risk profile for the banks, because that's the amount where they've got the most risk, because every mortgage they have outside of that's insured is insured, so they're super low risk, right?
Yeah.
And then when you start getting over $1 million, when you start getting to 30-year amortizations, when you start getting to refinances, those are the types of products that can't be insured even with portfolio insurance. So that's where it gets really expensive on the rates. And I think as of this filming, 5.04 is kind of the going rate for a
conventional
for a conventional 30-year amortization uninsured mortgage. And for an insured mortgage, it's what, 4.59? Or do you guys have better special rates than I have?
No, isn't that funny that, I mean, I can come into the market as a brand new buyer and put 5% down and have the whole mortgage insured on behalf of the lender in case of foreclosure, and I'm going to be 4.59. Whereas I sell that house and buy my third home, and I'm now putting 28% down, and I've got to go with a little bit of a longer amortization because I bought a more expensive home with a basement suite so I can afford to live there, and I'm paying 5.04. Right? you're penalizing people, which is kind of funny. But
it's a weird system. It really is. I mean, but at the same time, we say it's a weird system, and we kind of, we dissect it all. But if you look at it, it does work. I mean, in 2008, we saw the fact that the United States was having a real hard time. Did we follow suit? Absolutely, but definitely not as bad. We look at the stress test. Can you imagine if we didn't have the stress test right now?
Yeah.
I mean, it's a unique system, definitely, and on paper and like visually, it does not look appealing. But at the end of the day, it works, and it does protect us.
It does, totally. What do you think of this one? Check this out. In the US, did you guys see this? So the higher your credit
What?
now, the more it's going to cost you.
Why?
So the Biden administration, leading into an election year, put in a new rule that's aimed to provide equitable access to home ownership, which in other words means that if you missed your payments and you're not good at managing your credit, we want you to have the same opportunities to get a home. So we're going to give you a lower interest rate. Wrap your head around that one.
Wow.
So now there's incentives to have a couple of missed payments on your credit because that'll get you a lower interest rate.
It's so easy to do. Just be like, whoops, I forgot it the last 2 months. My bad.
Just do it on purpose. Just don't pay your last 2 months. And then, I'll catch up.
That's wild.
Isn't that crazy?
Is his age catching up to him?
Careful.
Sorry, I had to.
Don't forget how old I am.
No, not yours. Biden.
I'm 72. Yeah, I know.
Yeah. I got to take my shots when I can, but like that's insane to me. That's ridiculous. You work so hard to have good credit. You have to have good credit, and to have a rule like this come into play, it's just like, well, I'm glad I struggled through that. Thanks for kicking me while I'm down.
It really is backwards thinking, isn't it? Like we seem to be getting older and getting more technology and getting smarter, and yet some of the things that we do are just so backwards.
Yeah, and I mean, and we'll never get into a political discussion on this show because we just know from the YouTube algorithm, and so on and so forth, that's just going to kill a channel and it upsets people. But to talk about this without getting into political parties and affiliations and everything else, this is what happens when politicians play with markets in order to get elected, right?
100%.
And it's garbage. We're going to have a similar sort of thing going through Alberta here in the next little while. And I've never been looked at political parties on the right and left and went, how do I find one that's neither of those two? So it's really, really it's interesting. But I mean, hopefully we don't see that sort of thing coming to Canada anytime soon where, you get penalized for having really good credit. Right.
I would literally miss my credit card payment for like 2 or 3 months and just go refinance. It's good stuff.
Yeah. Or just go over limit for a month and that'll bump you down just enough.
Yeah. You know what? Do both. Go crazy with it.
Yeah. Why not?
Buy a new TV on credit card and just,
Yeah.
Wow,
and now we're gonna ruin our credit and never have a chance at getting a mortgage ever again, right?
Yeah. Yeah. Just for anyone watching, don't do those things that I just recommended.
Yeah.
No.
Do as I say, not as I do.
Yeah.
Right.
You pay your credit cards on time. It's very important that you pay your credit cards on time.
Yeah, absolutely. I mean, as an economist, I look at this stuff and I look at everything through the lens of incentives and disincentives and whatnot. And I think everything we've talked about today with respect to the banks failing, with respect to the housing market and the fact that things are going up in value still, and I think things like that, it creates this interesting conversation around psychology and how people are thinking. And I guess I got to ask you guys, like, where do you see people being at right now when they're coming into your office, they're applying for a mortgage and they're going, okay, rates went up, prices came down, it looks like they're going to go back up. What's their psychology? Are they thinking if we don't get in now, we're never going to get in? Are they thinking we just want a home to live in? Are they thinking screw it, we're just going to take a flyer and buy 7 rental properties? Like where are those people at right now?
I think perception is king, right?
Yeah.
And I think that the media is pumped out so much negative information over the last 24 to 34 months that people were scared. And now there's sort of a ray of sunshine. And I think that people there, again, are confident in their own ability to make payments and have some light at the end of the tunnel. I think the big thing is that people are looking at things now and saying, I'll never pay this house off, or I'll never,
Yeah.
so now you're looking at options and showing them different situations where they can do it. And honestly, maybe they don't pay the house off. Maybe you don't have to worry about that. But rather than pay $3,000 a month in rent, pay $3,400 in a mortgage. And I think that's their thought process now, is they're saying, at least I'm putting $1,500 towards my principal every month, where I think that people are a little bit more confident as long as they look at where they're spending their money, what they're doing. And, through COVID, people didn't spend any money. They saved everything. And, and all of a sudden now the lights have gone, the lights have gone on, the restaurants are busy. They can't find staff. People are renovating like crazy.
Yep.
So try to find somebody to put in windows or paint your place or anything. Like, it's nuts. So I think that consumer confidence, because people were beat up so bad, I think that they're back and they just want to win.
You're getting a bit of everything too, because there are those people too who are coming in thinking, okay, I didn't buy last year and I kind of regret that because, as the rates went up, yes, the prices went down, but it was still less affordable, right? I qualified for less. So I think you get this really steady mix of people. And I think Greg's right. When you talk about confidence, people are more confident in this market. We're seeing inflation go down. We're seeing interest rates go down. There's lots of good things out there, right? There's lots of negativity in the news and stuff, and you got to kind of wean through that. But I think especially millennials are really good at weaning through that stuff. And we're seeing more young buyers coming in. We're seeing a lot more of those millennials that still haven't bought houses going, okay, I'm ready. Let's do this. And it's inspiring, I think, is a good word. It's nice to see people happy and excited about the real estate market.
I have a question for you guys. Do you think that the younger age group now really wants more balance because they've gone through some of this stuff now, and they really want to make sure that not only do they pay off debts, save for a rainy day in retirement, and have fun, like they want to have some balance in their life? Do you think that that's more prevalent now?
Millennials are all about balance. They don't want to work really hard and then go traveling when they're old and retired. They want to do it now. But I think that for a while there, the fun knob was cranked a little too far over to the right. You can't crank it to 10. You got to have it in the middle. You can't have it at 0 because then, what's the point? So, and it's interesting too, because I think with young people and millennials, it's almost like there's generalization in the generation, right? Like, so for example, if you look at someone who's my age compared to someone who's like Nolan's age, right? Or even in my sister Andrea, the difference between me and her in that very slight amount of years is there's a difference there. And then you look at the millennials that are younger than me, and it's interesting because you'll notice that I think we're getting back to a point, because like I said, I think there was a point where the fun was cranked a little bit too far up, right? And I think we're starting to get back to a point where they're dialing it back and they're putting it back to where it should be. And we're not buying, millennials aren't buying their first houses in their early 20s, right? They're not buying them when they're just fresh out of, they're 20, 21 years old. They're not buying their first house. They're waiting till they're, late 20s, 28, 29, 30, 33. So I think that's kind of what we're seeing happen. And wow, I just got the notice that my battery is running low.
And you know what? Everybody every once in a while just has to go fishing.
100%.
Right?
I think if you're not going fishing at least once a year with a guy that's got a big red beard,
there's something wrong.
There's something wrong with you.
I think if that guy isn't going fishing at least once every 7 years, there's something wrong with him.
That's you know what? Yeah, okay. I steered right into that one. You got me. I love how people watching this are going to be like, what the hell are they talking about with fishing? What is this trip?
Oh, okay. Keep watching. We're going to do, there's going to be, someone's going to have to either shave a beard or jump in an ocean.
Very, very cold
in that
location.
In that trip.
I think Greg already shaved his beard, so why don't we just make him jump in the ocean?
No, you guys.
No, he's got to grow that beard back. It's in the thumbnails.
I mean,
absolutely.
I think this is interesting, right? Stats Canada last year released a whole bunch of data on net worth of homeowners versus non-homeowners. Now, the graph that I was able to quickly find here was for those born between 1955 and 1964. So these are people who are, let's call it retirement age, although that may not be a thing going into our futures. But if you take a look, like the numbers are staggering. If you own a home versus if you rent a home, Like owning a home is the single most reliable way for you to build your net worth for retirement.
Absolutely.
It's that simple, and the data doesn't lie about that. Now we on YouTube especially, there's a whole bunch of people who make videos about how renting's better, and they assume things like certain returns. They assume things like like uh like you're gonna like renting's cheaper. There's one guy who just did a video on this. I don't know if he's in Calgary, but he did a video on Calgary. He found two homes that he called identical. They were in different quadrants of the city. One had a garage, one didn't have a garage. One was finished like it was a home somebody was buying to live in, and one was finished like it was a home that they were going to rent out. And like the value on these homes was a $300,000 difference, which is a $1,500 mortgage payment difference. But he was saying that they were pretty much the same, and then he was showing that it was better to rent than to buy because of X, Y, and Z. But the reality is saving money over the long term isn't so much a math problem as it is a psychology problem, right?
Yeah.
So for millennials, the psychology problem is, do I want to buy or don't I want to buy? Well, if you want to make sure that you're going to grow your net worth, this makes it pretty clear that by retirement age, if you have a home, at least you have a chance.
You want to
Yeah.
own that home. It's
Yeah.
key.
Yeah.
It's funny. We've talked about this before. If you buy your first home at 33, or you rent, and you're making a similar payment for rent as you are for your home, even if it takes you 30 years to pay it off, you're 63 years old, and the house that you bought for, let's say, whatever the hell, 600,000. If it's still worth 600,000, you're way further ahead than having nothing. Like that's just simple math,
absolutely.
right? So I don't know. I don't see how. And there again, you can utilize that equity to do whatever the heck you want at that point. Give it to your kids, or
I find it really funny though that there's people on YouTube that are saying like, "Oh, renting is better," and it's I mean, if you look at it, you think the guy that's saying that owns his house?
No. And people will develop arguments for pretty much anything that supports their
absolutely.
position,
100%
right?
true.
So, I mean, just like it could be argued that three mortgage brokers are going to sit here and tell you to
Get a mortgage.
buy a
Like,
home.
we
And-
might have some bias.
yeah, totally. And
if we owned a rental agency, we might be different.
I
don't know.
Maybe.
Maybe.
Or we might just be telling you to buy
Buying more
rental
properties,
right?
Yeah.
I mean, and that's kind of the question I leads into the question I wanted to end on and ask you guys. Let's say in this market where housing market's a little tighter, interest rates are going up. There's a little bit of uncertainty there. Although we saw the Federal Reserve raise interest rates by 1/4 point at the beginning of May here when we're recording this, and they signaled that they're going to pause as well, especially what's going on with the banking crisis. But let's say you have $100,000 right now, and you're trying to decide: do I put it in real estate? Do I put it in the stock market and wait? What would you do right now today if you had $100,000 that you were going to invest? Where would you put it? What would you do?
If I was investing it,
Yeah, where would you put it?
There's
I
so
think
many
me and Greg
different
could put it
things.
in the same spot.
Yeah, I'd put it in my RSPs and when I get my tax return back. And there's
Yeah,
that's
a whole different video right there.
yeah, like it depends on your taxable income. There's all kinds of elements come into play, but it's diversification. Like you want to have
Yep.
a little bit of everything, right? You want to make sure you've got some kind of a pension plan, and if you build your own through RSPs and TFSAs, that's great. So there again, if you're getting a good investment right now, if you're getting a good return on a MIC at 8%, and you throw $100,000 in your TFSA because you're allowed to put in 86,000 right now if you've never bought one,
Yep.
like, and keep it in there for a year or 2 years and then get the money back tax free. Like there's all kinds of different elements you can look at, but I don't know if he who dies with the most properties wins.
For me, I kind of look at it. It's like,
I
if I had $100,000 just burning a hole in my pocket right now, I think the running thought is, oh, well, pay off your mortgage, which to me, I mean, I've got a variable right now. My interest rate's almost 6%, and I'm still not going to put that $100,000 on my mortgage. Not a chance. I would probably take it because, self-employed, I don't have a pension or anything like that. So I might be a little different than other people, but I'd be more inclined to take it, tuck it away in my RSP, invest that in something like Greg previously mentioned, a MIC or something that's, it's a private mortgage investment corporation. And
can you guys explain what that is?
I'll let Greg take that one. He knows more about them.
Yeah, it's funny because I mean, I'm an old guy, and I've had my stuff in mutual funds and all kinds of investments in the past. But a MIC is a mortgage investment corp, and it takes registered or unregistered funds, and it can take cash, and it puts it into a corporation, and then they lend it out to people who don't qualify for conventional financing. But they have an offering memorandum. They're registered to the BC Securities Act now. They have to be, and they're highly regulated. So, and it's lending money out to people who don't qualify for conventional financing. Yeah, and bad things happen to good people. So that's just sometimes what happens.
I mean, I've seen a number of situations where it's like Greg said, bad things happen, and someone needs an extra 30, 40, 50, $100,000. And they've got equity in their house. Well, they can use this private financing to access that, and it's open and all these sort of things. So it's a really useful product for those who need it. It can save people's lives, really. But for an investment side of things, I mean, like I said, I have no pension or anything like that, and I've got every dollar I make dialed into where it goes, and I have my RSP amount that I want to hit. And if I had $100,000, I'd tuck it right in that RSP. I'd rate that off against my income, take the check back I get from the government on my income taxes. I put that on my mortgage, right? So I'm paying my mortgage down. And then I'd invest that RSP and I'd let it ride until I turn 65.
Because there's a couple of things coming into play, which is a whole different episode too, the rule of 72, right? So you divide the rate of return into 72, and that's how many years it takes to double your investment. So if you put $100,000 in today and you're making an 8% return, that means in 9 years it doubles. Well, then if you're 33, 42, 51, 60, all of a sudden, you're 1, 2, 4, you're $800,000. Yeah. So, or do you take that $100,000 and put it on your mortgage and then borrow the money again to buy a rental property? Then you're right now 100% of the interest. I'm going really fast, but and that's and that's where that's another show too. But there's so many different things you can look at, and it absolutely depends on your personal situation.
Totally does.
And talking to somebody, a good financial planner and a good accountant and a good lawyer and Nolan Matthias.
Now, one thing I want to say too on that is, let's say someone's got $100,000 burn a hole in their pocket and they don't own a home yet. Take the $100,000 and put that in your RSP and invest it, and then ask mom and dad for the money for the down payment. There you go. No. I'm the only one here that doesn't have kids. So
hold on, even better. If there's two of you buying, take $35,000 each, put it into RSPs, leave it in there for 90 days, then take that out under the RSP program and use that for your down payment. And then when you get your income tax money back from your buying your $35,000 in RSPs each, you can put that into your TFSAs or there's
so many things you can do. Many things.
Bottom line, though, is it sounds like everyone needs to watch the episode from Tony Spagnuolo on how to steal a house from your parents.
Absolutely. That is key.
You got it.
Guys.
You're not supposed to talk about that when me and Greg are both on the line. That's just you and me, Nolan. Come on, man. Come on.
I love it. We talked about a lot today. Great episode, guys. I enjoyed that one. We're gonna have to bring a realtor on next week, I think, in order to allow them to defend themselves, because I went pretty hard on attacking realtors at the beginning of this. So I'll make sure they're prepared with all of their mortgage broker jokes, right?
That's absolutely fair. And I'm gonna wear my Robert Graham white shirt too.
I think we should have, if we have a realtor on on the next episode, we have to have a section where we come up with realtor jokes and they have mortgage broker jokes, and we just shoot them back and forth just for or interject them ever so subtly into the episode.
I love it.
It sounds good time.
Cool. Well, we'll set that up for next week. Next episode, we are going to have a realtor.
Perfect.
Beautiful.
Maybe a YouTube realtor that some of my audience might know.